Now, $10 intraday upside moves will simply accelerate a move above the 200-day moving average, after which don't rule out a very quick rinse of short stop layers, ultimately resulting in a doubling of current synthetically influenced prices into $140 by the end of the fourth quarter. Silver continues to look extremely attractive at current prices. And as we opened with, and we talked about $6,000 gold, and we talked about $8,000 gold.
Gold and silver are decoupling from mechanical correlations as global capital shifts decisively away from ballooning debt obligations. Mainstream financial media continues to blame short-term headlines, completely overlooking the massive, physically driven run into allocated tangible reserves. Andrew Maguire, a renowned precious metals expert and institutional trader, emphasizes that synthetic paper suppression is unraveling as sovereign accumulation accelerates across global markets. This widening divergence between leveraged paper contracts and physical bar availability is setting the stage for an explosive repricing event. Technical momentum above long-term moving averages is expected to trigger rapid short covering, projecting silver to double from synthetically suppressed levels into a $140 by the end of the fourth quarter. Meanwhile, persistent monetary accumulation and structural vault drain are keeping the core $6,000 gold baseline firmly intact, with intensifying physical flows making an eventual surge toward $8,000 highly magnetic. Now, we present the clips from Andrew Maguire's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
Gold is increasingly coupling from mechanical correlations, rising despite stronger equities and higher yields. Now, in typical form, trying to pin gold's rally on Iran peace headlines and rate cut hopes, the previously bearish skewed mainstream media is after the fact, and again after the fact, once again chasing the reason why gold suddenly broke out of its 6-week consolidation range. That's just more retrofitted noise. The real story is far bigger, deeper, and far more bullish. It's a physically driven race out of ballooning US dollar debt into first-tier gold. This is not about one geopolitical headline or the next Fed rate cut. It's about the world's largest reserve holders all at once waking up to the same problem. Sovereign debt is exploding. US dollar reserves are becoming harder to use, and the only clean escape route into zero counterparty risk, physical gold and silver. That is your only escape route. And that's true for all of us. Silver is also displaying the same bullish inputs, both short and longer term. There's a couple of links here, which I thought were worth sharing. Again, from Marketeer. It broke through its 64 resistance. Again, now we're looking at the next resistance at 68. Well, that isn't going to be long before it gets breached, because the 200 is coming to view. And guess who missed it? The speculators. They got out just before the squeeze was higher. Now, that was absolutely orchestrated by the commercials. 100%. We talked about it before. So basically, what we're looking at now is the move above the 50, and we agree that bigger resistance comes through at about 72, which is the 200-day moving average. Actually, we can adjust that a little to what it really should be. And if we scroll down to where the moving averages are. Now, the reason I've got two 200-day moving averages here. The reason I put both in is because silver is basically trading as an expiring futures contract, so it should be trading at par. However, the spot adjusted number, and it's spot really that determines the real price. This is purely synthetic. The spot price is actually 71.74. So yes, in round numbers 72, but that's rising every day a little. But essentially a breach of that, and we're going to see probably some foot stamping on an attempt at 70.71, but I think we're going to see some also buying coming through at the 100-day moving average, which is what we saw in gold right here. So silver's breakout is gaining reinforcement from positioning, systematic flows, and options demand. We see some light managed money positioning, very, very small, and they've only just started to get back in. Leaves lots of room for fresh fund buying to extend the rally. And we have dollar weakness, and silver's divergence point to really further catch-up potential. So we're seeing CTA short covering and renewed call buying. It's all adding fuel to the move. And much like we looked at the Fibonacci retracements, this is also a determinant of the daily spot chart, which is basically 64.84, and we're going to likely see 75.87. A pit close above the 71.74 200-day moving average with strength and confirmation, and will accelerate upside momentum. You'd be amazed how quickly silver can rise. And one thing that we ought to point out is that people are talking about the lease rates and not reflecting a tight market. Well, but what it is while paper market unallocated short covering means London lease rates do not yet fully reflect emerging physical tightness because of cash settlement, strong physically settled global demand should quickly arbitrage the paper squaring lag and rapidly tighten the local London float. Recording this on Wednesday, and today, silver, driven by close to 12.75, close to 13% Shanghai silver premiums, and Chinese ETF re-engagement, spot silver just fixed at its highest level since the 17th of June, in very strong physical demand. So while on silver, let's look at what to expect. As institutional refiner and hedging flows migrate into the Hong Kong SGE trading hub architecture, silver is also benefiting from gold's physical settlement structure, leaching silver out of the LBMA cartel ring fence. We experienced $10 downside intraday moves in silver as the price reset closer to physical demand prices. That was on the way down. Now, $10 intraday upside moves will simply accelerate a move above the 200-day moving average, after which don't rule out a very quick rinse of short stop layers, ultimately resulting in a doubling of current synthetically influenced prices into $140 by the end of the fourth quarter. Silver continues to look extremely attractive at current prices. And as we opened with, and we talked about $6,000 gold, and we talked about $8,000 gold. And essentially what we're seeing here, it is unfactored the difference that a physical settlement and the arbitrage flows between the HAU after it was launched versus the gold fixes has forced commercials and those making markets, and the fixes have to be NSFR compliant at the fix, forced them to raise the bid. And that is why our liquidity providers, global facing liquidity providers, see such a dramatic move higher that we do expect $6,000 gold and $8,000 gold potentially into the end of the fourth quarter. So this is not pie in the sky. We've seen a full retracement. We've seen a full settlement. And a lot of this happened very close to the 38250. And now we are looking at a potential move higher.
The widening disconnect between leveraged paper contracts and deliverable physical metal is generating massive friction across precious metals trading desks. Commercial market makers orchestrated brief intraday shakeouts ahead of month-end positioning, temporarily dislodging speculative traders right before an aggressive physical squeeze commenced. High Eastern spot premiums and renewed retail engagement have begun pulling substantial bullion volume away from Western vaults, rapidly drying up available London float liquidity. While cash-settled paper lease rates lag behind real ground conditions, systemic arbitrage is forcing synthetic pricing to align with deliverable bullion reality. Renewed commodity fund buying, options positioning, and systematic short covering continue to add substantial fuel to the current upside breakout. As technical charts challenge major resistance barriers, the market is shifting decisively from synthetic leverage toward deliverable physical settlement. Now, let's get back to the interview.
Now, sustainable rallies require some constructive periods of consolidation. Small pullbacks are healthy. Later on, we're going to look at the next month's third quarter and end of fourth quarter targets. That's going to be really interesting, and you'll be amazed. Spoiler alert. Here are the unchanged beginning of the year minimum 6,000. That's still on. And we also look at the reasons $8,000 will become magnetic. So let's look sequentially at the footprints that followed the short-term bearish action into month-end BIS squaring. You remember that's because the Fed has to square leased positions at the end of each month, and they mark them to market. They try and do it as low as possible. And we just recorded it literally a day before that. These footprints were colliding with very, very large T+1 delivery, 400-ounce bar outflows into the the recently launched Hong Kong SGE hub, which has been underestimated. I've seen podcasts out there where they say this won't make any difference. It's beyond believable how much of a difference this is making, because this is further compressing the bearish paper versus physical gold spring, which was not factored in. Now, while the bearish paper market action into the end of July emboldened these commodity trading advisor shorts, they, along with an array of mainstream media commentators, got the wrong message until just as the trading desks thinned out and the Hamptons holiday homes started filling up last Wednesday. The underestimated Hong Kong SGE physically driven upside breakout commenced, blindsiding them. Now, we've seen these midsummer structures play out before, but global gold has never experienced such strong midsummer central bank support. And this only lists official purchases, not the much larger unreported monetary gold accumulations that we've been reporting for quite some time. Now, the most likely scenario was exactly what we've just experienced. A whale-size physically driven rally has now been triggered, and the bullish case for August continues to rest on a tightening physical market, accelerating Eastern price discovery, sustained bank and sovereign accumulations, shrinking LBMA 400-ounce liquidity, and the widening disconnect between leveraged paper selling and real deliverable physical demand. Now, as this divergence becomes harder to ignore, mainstream analysts are likely to recognize that the current weakness was not a bearish trend, but a spring-loaded event ahead of really what is going to become physical repricing. They are not onto the physical repricing yet, but they will be. I mean, the gold breakout commenced because, and this is the key, the reserve race has started. Mainstream media, once again, are chasing gold's breakout after the fact, blaming Iran's headlines, rate cuts, hopes. That's just noise. The real driver is a much bigger structural shift. Central banks and sovereigns are cutting exposure to ballooning US dollar debt and racing into first-tier physical gold. It's that simple. Japan provided the warning shot. It needs cash to defend a weakening currency, but selling too much of its more than 1.1 trillion treasury stack, what it does is risks putting the US yields, pushing the US yields higher and marking down the reserves it still holds. It's quite the condition. That is the treasury trap. And every major US dollar creditor can see it. Now, the Financial Times had already flagged the key point, which is Washington does not want foreign central banks freely using their dollar reserves if that destabilizes US markets. The translation of that is the dollar reserve asset is no longer as freely usable as advertised. Once that message lands, reserve diversification accelerates. There's only one scalable, neutral, zero counterparty reserve asset outside of the sovereign debt system, physical gold, not paper promises, not another issuer's liability, first-tier deliverable gold. And that's why the gold repatriation trend, the expanding Hong Kong SGE corridor, Laos's moved towards physically anchored price discovery, and South Korea's first central bank gold purchase in 13 years. All of these things matter. These are not isolated headlines. They're just a few visible confirmation signals of a much wider gold de-dollarization move, which was actually seeing this expand into Singapore, Saudi Arabia, the UAE, Africa, Latin America. What it's also doing is sucking in unfactored Western participation as the global-facing SGE vortex gathers momentum. And as we drew attention to last time, the Laos integration was especially important because it marked the Southeast Asia's first clear move away from paper-diluted, cash-settled LBMA fixes and towards the Hong Kong SGE architecture and its physically determined HAU price ticker, which is physically determined. And this is how true physical price discovery starts to migrate east, corridor by corridor, exchange by exchange, and sovereign by sovereign. The race is actually now on. And more recently, South Korea, as I say, announced its first gold purchase in 13 years. Citing, what do they cite? Persistent geopolitical risks. They cited gold's role as an inflation hedge. Goodness me, I mean, seems like this is too old school. And its potential as an alternative to the US dollar. But this is not the signal. Central banks and sovereigns are not waiting for permission. They're cutting exposure to ballooning US dollar debt and racing into first-tier physical gold. Gold is not breaking out because of short-term headlines. It's breaking out because the reserve system is changing right beneath the surface. US dollar debt is ballooning, treasury liquidity is constrained, and sovereign reserve managers are moving toward the only asset that carries no issuer risk, physical gold.
Sovereign reserve holders across the globe are waking up to the structural reality of the treasury trap. Major foreign creditors holding massive U.S. debt portfolios face mounting operational constraints, as deploying dollar reserves to stabilize domestic currencies risks triggering sharp bond yield spikes and balance sheet markdowns. Consequently, central banks throughout Asia, the Middle East, and Latin America are accelerating unilateral diversification away from foreign sovereign debt into zero counterparty physical assets. South Korea's recent decision to resume official bullion purchases after a 13-year pause illustrates the intensifying institutional search for durable monetary reserves. At the same time, regional market architecture is undergoing a profound structural evolution. The integration of institutional refining pipelines into the Hong Kong trading hub allows market participants to bypass paper-diluted London fixes entirely. Operating under strict physical settlement mandates and net stable funding rules, participating institutions are forced to bid directly for allocated bars. This ongoing institutional migration ensures that true price discovery is permanently shifting eastward, fundamentally dismantling synthetic paper influence across sovereign balance sheets. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.